90 minutes. That's all it took. 90 minutes for Washington to erase trillions of dollars from the market. No war, no recession, no banking collapse, just a regulatory decision. And suddenly, the most valuable sector in the American economy was bleeding out on the trading floor. If you've been following the AI gold rush, you already know the stakes. We're not talking about a niche tech experiment anymore. We're talking about the backbone of the next financial era. And someone just pulled the plug. Welcome to the story of how the United States government turned artificial intelligence into a financial weapon and pointed it directly at Wall Street. If you want to understand where the real money moves before the headlines catch up, subscribe to Finance Stories right now. Hit that button. Turn on notifications. Because what we're about to break down is exactly the kind of information that separates the investors who see it, coming from the ones who are left reading the postmortem. Let's start with Anthropic, for those who haven't been paying attention. And if you haven't, this is your wake-up call. Anthropic was supposed to be the darling of the AI investment world, founded by former OpenAI insiders, backed by Google, Amazon, and a constellation of venture capital firms that read like a who's who of Silicon Valley royalty. Anthropic built Claude, an AI model that was genuinely competing at the highest level. Not just technically, financially, the IPO whispers were getting loud. Analysts were throwing around valuations that made even seasoned investors raise an eyebrow. We're talking numbers north of $40 billion. Some projections pushed towards 60. The roadshow hadn't even started, and the institutional money was already circling. Hedge funds were repositioning. Portfolio managers were making room. The smart money was moving, because the smart money believed that AI was not a trend. It was infrastructure. It was the new oil pipeline, and Anthropic was building the refinery. Then Washington walked in. Under the framework of export control regulations, specifically an expansion of rules originally designed for semiconductors and military hardware, U.S. government began treating certain AI models as export-controlled technology. The logic, if you want to call it that, went something like this. Advanced AI could be used for military applications. Therefore, advanced AI must be subject to the same controls as weapons systems. Anthropic's models, under this framework, became subject to restrictions that limited how they could be deployed, who could access them, and critically, how they could be monetized internationally. The IPO math changed overnight. When you're building a $40 billion valuation story, a significant portion of that story is global revenue. Enterprise contracts in Europe, licensing deals in Asia, API access sold to companies from São Paulo to Singapore. Is 3P that ouchie? Or bury it under a mountain of compliance costs, licensing restrictions, and regulatory uncertainty, and your $40 billion story starts looking a lot more like a $20 billion story. Maybe less, depends on how nervous the institutional buyers are feeling that quarter. And institutional buyers, it turns out, get very nervous very quickly when the word munitions enters the conversation. That's not a metaphor. That's the actual legal framework being applied. Export administration regulations, the same category of law that once governed encryption algorithms, the same category of law that once made it technically illegal to export certain cryptographic software without a government license. If that sounds familiar, it should, because we've been here before. And the last time we were here, it cost the industry years and billions of dollars in stunted growth. Let's talk about that comparison for a moment, because the history is instructive and a little bit maddening. In the 1990s, the United States government classified strong encryption as a munition, not a metaphorical weapon. An actual, legally designated munition, subject to the international traffic in arms regulations. The result? American companies couldn't freely export encryption software. Foreign competitors, operating outside U.S. jurisdiction, faced no such restrictions. The government, in its infinite wisdom, had decided that keeping encryption technology bottled up inside American borders was somehow making America safer. What it was actually doing was making American tech companies less competitive, more legally exposed, and deeply uncertain about how to plan for international growth. Sound familiar? The policy eventually changed after years of lobbying, court battles, and the quiet acknowledgement that the entire internet was built on encryption and maybe treating math as a weapon had been a strategic error of some magnitude, but the damage had been done. Companies had made decisions. Capital had been allocated elsewhere. Opportunities had been missed. Now replace encryption with large language models and you have the current situation with Anthropic. And with every other AI company operating at the frontier. Here's where it gets particularly ironic. And if you've been following American politics for more than 5 minutes, you'll appreciate the layers here. The same administration that campaigned loudly on deregulation. The same political movement that built an entire brand identity around getting government out of the way of business, out of the way of innovation, out of the way of the market. That movement, One Zine Power, reached directly into the most dynamic sector of the American economy and installed a kill switch, not a regulatory framework. A kill switch. Because that's what export controls on AI models effectively create, a mechanism by which Washington can action a moment for any reason that falls within the broad and flexible language of national security, restrict, limit, or entirely shut down the commercial deployment of AI technology. Wall Street noticed. Of course it did. Wall Street always notices. The question is, what happens after it notices? And what happened after it noticed the Anthropic situation was not pretty. The immediate market reaction was the kind of thing that makes risk managers lose sleep. AI-adjacent stocks took hits that, in aggregate, represented the kind of value destruction that would have been front-page news in any other sector. But because it happened across a distributed portfolio of holdings, a little off here, a little off there, a quiet repricing of risk premiums across dozens of positions. It didn't produce a single dramatic headline. It produced something potentially worse, a slow, grinding realization among institutional investors that AI valuations had been built on an assumption that was no longer safe. To me, the assumption was simple, that the United States government would treat AI companies the way it had treated, say, social media companies in their growth phase. With benign neglect, with a vague sense that innovation was good, that American tech dominance was desirable, and that the best thing the government could do was stay out of the way and collect taxes on the profits. That assumption is now dead. And when an assumption that's been baked into trillions of dollars of valuation dies, the repricing doesn't happen all at once. It happens in waves. First, the smart money adjusts. Then the institutional money adjusts. Then the retail investors, who are always the last to know, look at their portfolios 6 months later and wonder what happened. What happened is that Washington inserted itself into the AI investment thesis in a way that cannot be ignored and cannot be easily modeled. This is important, so let me say it plainly. The core problem for investors is not that there are regulations. Regulations can be priced in. Compliance costs are real but manageable. What cannot be priced in, what creates genuine, systemic portfolio risk is regulatory uncertainty, combined with the threat of retroactive enforcement and the possibility of sudden, politically motivated restriction. That's not a risk factor. That's a variable that breaks financial models. Think about how AI companies are currently valued. You're looking at a combination of current revenue, projected revenue growth, total addressable market, and critically, the assumption of continued operational freedom, the ability to keep deploying, keep selling, keep expanding. Strip out that last assumption and the entire discounted cash flow analysis falls apart. Banks that have integrated AI infrastructure into their operations are now facing a compliance question they genuinely didn't anticipate having to answer. What happens if the AI system we've built our credit analysis on, our fraud detection on, our customer service infrastructure, on what happens if that system gets classified as export control technology and our vendor loses the ability to operate it the way we've been using it? That's not a hypothetical. That's a question being asked in legal departments right now. And legal departments, when they start asking questions like that, tend to respond by either slowing down adoption or demanding contractual protections that AI vendors may not be able to provide. Neither outcome is good for the AI sector's growth trajectory. Both outcomes are already being reflected in private conversations that will eventually show up in quarterly reports. If you're still watching and you haven't subscribed yet to Finance Stories, what are you waiting for? And if this breakdown is giving you a new perspective on how Washington moves markets, drop a comment below and tell us how you're thinking about AI exposure in your portfolio right now. And hit that like button. It genuinely helps us keep bringing you this kind of analysis. Now, let's talk about the part of this story that Washington really doesn't want you to think about. Because while American AI companies are navigating export controls and compliance costs and regulatory uncertainty, the rest of the world is not standing still. China is not standing still. The emergence of genuinely competitive Chinese open-source AI models is not a future threat. It is a present reality. Models that are freely available, aggressively priced, and here's the critical part, entirely immune to American regulatory action. When an American enterprise is choosing between an AI vendor that comes with regulatory uncertainty, compliance overhead, and the theoretical possibility of a Washington kill switch, and an alternative that carries none of those specific risks, the calculus changes, the risk profile changes, the total cost of ownership analysis changes. This is not an argument about which model is technically superior. Technical superiority is a temporary condition in AI. Models improve. Capabilities converge. What doesn't converge is regulatory exposure. What doesn't improve on its own is the political risk premium attached to American AI vendors operating under export control frameworks. International companies, European enterprises, Asian financial institutions, Latin American banks are already running this analysis, and some of them are reaching conclusions that the American AI industry is not going to like. The irony is almost too perfect. The export control framework, designed ostensibly to prevent American AI technology from falling into the wrong hands, is creating a competitive dynamic that is actively pushing international customers toward alternatives that have zero connection to American regulatory frameworks. The policy designed to protect American technological advantage may be doing more damage to that advantage than any foreign competitor could have managed on their own. Let's put this in historical context one more time, because the dot-com comparison is too important to skip. In the late 1990s, the dot-com bubble was not just about irrational exuberance and business models built on wishful thinking. It was also about a fundamental repricing of what the internet meant for corporate valuations. Companies were valued not just on current earnings, but on their projected dominance of an entirely new economic layer. The internet was infrastructure. The internet was inevitable. The internet was going to touch everything. Sound familiar? What the dot-com crash actually corrected was not the underlying thesis. The internet did become infrastructure. The internet did touch everything. But the assumption that growth would be uninterrupted, that regulatory and market friction would remain minimal, and that the transition from promise to profit would be smooth and linear. The correction was brutal, not because the technology was wrong, because the assumptions surrounding the technology's deployment were wrong. AI valuations today contain similar assumption structures. The technology is real. The applications are genuine. The long-term economic impact may be as significant as the internet, but the assumptions about regulatory environment, about political stability, about the continued freedom to deploy and monetize those assumptions are being tested right now. And the test is coming from inside the house. Here's what every investor, every portfolio manager, every CFO building AI into their strategic plan needs to understand about the current moment. Washington has discovered that AI is not just a technology sector, not just an economic driver, a geopolitical lever, and geopolitical levers get used. The history of American export control policy is the history of economic tools being deployed for political purposes, sometimes with clear strategic logic, sometimes with logic that only becomes clear years later, and sometimes with logic that never becomes clear at all because it wasn't really logic. It was politics, wearing the costume of strategy. The classification of AI models within export control frameworks gives Washington a tool it has never had before: the ability to reach into the commercial AI ecosystem and turn the dial up or down based on political calculations that have nothing to do with market fundamentals. That is not a risk factor that any earnings model was built to handle. That is not a scenario that IPO valuations were priced to reflect. That is the kill switch. And now that Washington knows it exists and knows how to use it, the probability of it being used again and used more aggressively and used with less notice is not zero, is not even close to zero, is, in fact, the kind of probability that a rational risk-adjusted investor needs to incorporate into every position they hold in the AI sector. The implications cascade. If you hold a I company stock, direct exposure. Obvious. If you hold bank stocks or financial sector ETFs, and those banks have integrated AI into core operations, you have second-order exposure to this risk. If you hold tech-adjacent positions, if you hold venture-backed companies that depend on AI infrastructure, if you hold any position in any company that is projecting future earnings based in part on AI-driven efficiency or AI revenue, you have some level of exposure to this risk. And most investors are not currently pricing this risk correctly, because most investors are still operating on the assumption that the regulatory environment for AI will look something like the regulatory environment for social media: vague, delayed, politically contentious. But ultimately, that assumption may be wrong. And the cost of that assumption being wrong is not a small percentage move in a single stock. It's a fundamental repricing of the AI investment thesis across the entire sector. Here's the bottom line, and it's the kind of bottom line that should make every serious investor uncomfortable. The most significant risk to American AI investment is not Chinese competition. It's not technological stagnation. It's not even the question of whether AI models will actually deliver the productivity gains that the valuations are pricing in. The most significant risk is this: the United States government has installed a kill switch in the most valuable sector of the American economy. It has done so under a legal framework that is broad, flexible, and subject to political interpretation. It has done so while simultaneously claiming to be the champion of deregulation and innovation. And it has done so in a way that is already driving international customers toward alternatives that carry none of the same regulatory exposure. The real monopoly in American AI is not any single company. The real monopoly is Washington's ability to decide at any moment which innovations survive and which ones get reclassified as weapons. The irony writes itself. The country that built its economic identity on free markets and limited government intervention has handed its political class a switch that can turn off the innovation engine whenever the political calculus demands it. And the investors who didn't see it coming will spend the next decade trying to explain to their clients why they didn't. You saw it coming because you were here. If this breakdown changed how you're thinking about your AI exposure, tell us in the comments. We read every single one. Drop a like if you think more investors need to hear this analysis. And right there on your screen, the next Finance Stories video is already waiting for you. And trust us, after what we just covered, you're going to want to see where this goes next.